Royal Gold is a precious metals royalty and streaming company positioned as a capital-light vehicle for commodity exposure characterized by exceptionally high operational margins. The company is currently navigating a period of strategic transformation following the transformative acquisitions of the large, long-life Kansanshi gold stream and the expanded Sandstorm Gold/Horizon Copper portfolios. This period presents a complex financial picture defined by record operational cash flow generation simultaneously offset by a substantial strategic deployment of capital that has resulted in a temporarily negative trailing free cash flow (FCF). Royal Gold have a discount relative to its Tier 1 peer group, which includes Franco-Nevada Corporation and Wheaton Precious Metals. The stock's re-rating potential is contingent upon the successful integration of the acquired assets and the timely execution of the stated deleveraging plan. The market is anticipated to eliminate the current discount as the accumulated cash flow from the expanded portfolio rapidly normalizes the debt-to-EBITDA ratio, driving significant multiple expansion and capital appreciation over the subsequent 18 to 24 months. B. The strategic advantage of the royalty/streaming model. RGLD operates under the royalty and streaming business model, which involves providing upfront capital financing to mining operators. In return, RGLD secures the right to purchase future metal production at fixed, reduced rates. This structure insulates RGLD from the variable and inflationary operating costs faced by traditional miners, effectively mitigating production risk and operational price inflation. The third quarter of 2025 financial results clearly demonstrated the model's margin supremacy, yielding record revenue of $252.1 million, backed by an adjusted EBITDA margin of 82%. This margin profile is demonstrably superior to those achievable by conventional mining companies, establishing RGLD's profitability and resilience. The company's portfolio has been strategically enhanced to improve scale, longevity, and diversification. Post-acquisition, the portfolio expands to 40 producing assets, with approximately 60% of 2024 revenue sourced from politically stable, low-risk Tier 1 jurisdictions, including 35% from Canada, 17% from the United States, and 4% from Australia. While gold dominates the revenue stream at 78%, the contributions from silver, 12%, and copper, 7%, provide material commodity diversification and stability. I. Analysis of cash flow dynamics and growth trajectory. RGLD's recent operational performance has been exceptionally strong. The third quarter of 2025 delivered record financial outcomes, including $252.1 million in revenue and a record operating cash flow (OCF) of $174.0 million, resulting in robust net earnings of $126.8 million. This performance was driven by the advantageous positioning of the portfolio during a period of materially higher gold and silver prices, achieving a sales volume of 72,900 gold equivalent ounces, GEOs. However, the analysis of cash flow must differentiate between operational cash generation and capital deployment activities. While operational cash conversion has been excellent, the substantial capital outlay required for the Kansanshi stream acquisition and the subsequent Sandstorm/Horizon Copper portfolio additions has overshadowed the trailing free cash flow, FCF. This growth-oriented deployment led to RGLD reporting a negative trailing 12 months TTM levered free cash flow of approximately negative $743.33 million. It is critical for investors to recognize that this negative FCF figure is a temporary, non-recurring consequence of aggressive strategic merger and acquisition spending, rather than an indication of fundamental operational cash flow deficiency or poor cash conversion. The high current OCF provides the necessary internal financial strength to service and rapidly reduce the acquisition debt. B. Capital structure and post-acquisition debt management. To finance the recent transformative acquisitions, RGLD increased its leverage, drawing $825 million on its existing revolving credit facility. This resulted in an increase in total debt to $770 million as of September 30, 2025, against total shareholder equity of $3.4 billion, establishing a moderate debt-to-equity ratio of 22.5%. This level of leverage is deemed manageable given the stability and predictability of the company's royalty cash flows. Management has provided a clear and disciplined financial strategy, committing to utilizing the immediate, accelerated cash flow generated by the now enlarged portfolio to repay the outstanding debt. The projection is to fully repay the debt within 2 years following the closure of the Sandstorm and Horizon transactions. This confidence in rapid deleveraging is supported by tangible actions. RGLD has already executed on its objective by arranging the disposition of non-core Versamet royalty shares for aggregate consideration exceeding $200 million, with all proceeds explicitly earmarked for debt reduction. This proactive debt management reinforces the confidence in the 2-year timeline. Furthermore, the firm has a credible history of disciplined debt repayment, having previously retired $575 million in debt within 7 quarters following a prior series of acquisitions. This historical precedent substantially increases the credibility of the current 2-year paydown target. C. Future cash flow accretion and growth catalysts. The integration of the newly acquired portfolios is expected to deliver immediate and material revenue accretion. The Sandstorm and Horizon transactions are anticipated to contribute an immediate increase in gold equivalent production estimated to be between 65,000 and 80,000 GEOs in 2025. These additions will begin to normalize and significantly augment cash flow metrics starting in the 4th quarter of 2025 and accelerating into 2026. Beyond the immediate boost, RGLD's long-term cash flow sustainability is solidified by a strong development pipeline. The Sandstorm acquisition added exposure to key projects such as Platreef, which is scheduled to commence Phase 1 production in late 2025. Once fully operational across all 3 phases, Platreef is projected to become the world's largest platinum group metals mine. Concurrently, the Back River Goose project, where RGLD holds royalty interests, achieved commercial production in October 2025. This project is expected to deliver approximately 250,000 ounces of gold in 2026. The strength and longevity derived from these new substantial revenue sources provide the foundational data that underpins the highly ambitious long-term FCF forecasts, which predict RGLD's annual FCF potentially surpassing $1.06 billion by 2035. I. Assessment of dividend safety and payout policy. A. Stability and track record. Royal Gold holds an exceptional status among corporate dividend payers, boasting a consistent track record of increasing its annual dividend for 21 consecutive years. This longevity is particularly noteworthy in the cyclical mining and materials sector, confirming the resilience of RGLD's royalty-driven cash flow stream across various commodity price cycles and macroeconomic environments. The company continues to demonstrate a commitment to compounding shareholder returns, maintaining a strong 5-year annualized dividend growth rate approaching 10%. B. Coverage metrics and financial flexibility. The dividend is demonstrably secure, supported by highly conservative coverage metrics. RGLD's dividend payout ratio is reported as extremely low, ranging narrowly between 24 and 26% of earnings or operating cash flow. A payout ratio this low, significantly below the typical threshold of 60 for safety, indicates that the company uses only a minor fraction of its available cash resources to fund distributions. The existence of such an extremely conservative payout ratio is a critical component of RGLD's current capital management strategy. By retaining approximately 75% of its gross operating cash flow, RGLD generates substantial internal capital which is directly allocated to rapid debt repayment. This massive cash retention capacity is the primary financial mechanism that ensures the 2-year debt paydown commitment can be met without compromising the dividend commitment. This structure illustrates that the company's objective of growth via M&A and subsequent debt reduction does not create a conflict with its long-standing dividend maintenance policy. The dividend is therefore fundamentally secure and internally prioritized, even during this aggressive deleveraging phase. C. Management commitment during transformation. RGLD management has recently reinforced its commitment to capital distribution, announcing a 12.5% increase in its quarterly dividend to 45 cents per share. The timing of this double-digit dividend hike is strategically significant. Executing such a raise immediately after incurring substantial debt for large-scale acquisitions conveys management's deep confidence in the immediate and accretive nature of the acquired cash flows. Furthermore, RGLD explicitly communicated its intention to prioritize and maintain the dividend commitment while simultaneously executing the plan to pay down the acquisition debt. This confirmed financial policy signals stability and confidence to long-term investors.
IV. Valuation analysis and peer comparison. A. Intrinsic value perspective, DCF. Intrinsic valuation models provide a strong case that RGLD shares are currently trading at a measurable discount. A rigorous discounted cash flow (DCF) calculation applying the two-stage free cash flow to equity model estimated an intrinsic value for the company at $209.24 per share. Based on this assessment, the stock is currently estimated to be trading at a substantial 19.2% discount compared to its calculated fair value. This optimistic intrinsic valuation is based on the superior characteristics of RGLD's asset base, including long asset lives and high-quality jurisdictions, which support projections of steady and substantial FCF growth. Specifically, forecasts anticipate that RGLD's FCF will grow rapidly following the integration phase, potentially reaching $1.06 billion by 2035. B. Distortion in trailing multiples. While the DCF analysis points to undervaluation, RGLD's trailing valuation multiples currently appear elevated, reflecting the transitional phase following the debt-financed M&A activity. The company's latest 12 months LTM enterprise value to EBITDA (EV/EBITDA) is 17.2 times, marking a significant increase compared to its historical 5-year median of 10.5 times and average of 10.7 times. Similarly, the price-to-earnings (PE) ratio stands at an elevated 35.2 times, contrasting sharply with a peer sector average of 21 times. The elevation of these trailing multiples is fundamentally due to a temporary imbalance created by the M&A timeline. The increase in the numerator, enterprise value, which incorporates the $825 million of drawn debt, occurred immediately upon the transaction closing. Conversely, the denominator, TTM EBITDA or TTM net income, has not yet fully accounted for the subsequent cash flow contributions from the acquired Consanti, Sandstorm, and Horizon portfolios. As the pro forma cash flow from these accretive assets is fully recognized in future quarters, the denominator will increase rapidly. This cash flow accretion is the mechanism by which the EV/EBITDA multiple is expected to normalize, compressing toward its historical median as the temporary acquisition distortion is resolved. C. Relative valuation against sector peers. RGLD consistently trades at a discernible and quantifiable discount relative to its primary Tier 1 royalty peers based on forward earnings multiples. Specifically, Royal Gold is valued at approximately 21 times forward earnings. In contrast, Wheaton Precious Metals (WPM) commands a premium multiple of 23 times forward earnings, and Franco-Nevada Corporation, the established sector leader, achieves the highest valuation at 28 times forward earnings. This persistent discount, amounting to a 7-point gap relative to FNV's forward PE, is largely attributable to the market's traditional preference for FNV's superior scale, broader commodity exposure, including participation in the energy sector, and historically perceived slightly lower jurisdictional risk profile. RGLD's recent transformative M&A strategy was precisely engineered to address and close this gap in scale and portfolio diversification. The successful execution and verifiable delivery of the 2-year debt paydown goal will serve as the crucial catalyst needed to validate the financial benefits of the expanded portfolio. This validation is expected to lead to a significant market re-rating, driving RGLD's valuation multiple closer to parity with both WPM and FNV. V. Conclusion. Royal Gold has demonstrated exceptional financial resilience by successfully executing a period of aggressive, necessary growth capital deployment while steadfastly adhering to financial discipline. The company's core operational strength is confirmed by record operating cash flow generation. The dividend structure is exceptionally secure, reinforced by a payout ratio positioned conservatively in the mid-20s, and management has explicitly protected this commitment throughout the current deleveraging cycle. The balance sheet remains fundamentally robust for a growth-focused entity, with a debt-to-equity ratio of 22.5%. Furthermore, management's decisive actions such as the rapid divestment of non-core assets with proceeds specifically allocated to debt repayment strongly confirm the prioritization of debt reduction. Royal Gold Incorporated presents a compelling investment opportunity to acquire a high-quality streaming company at a substantial discount. The current market price suggests the stock is undervalued by nearly 20% relative to calculated intrinsic value and trades at a material discount of several turns on forward earnings compared to its largest peers. The primary perceived risk, the temporary increase in debt load, is rigorously mitigated by management's explicit, time-bound commitment to deleveraging within 2 years. This commitment is strongly supported by substantial, high-margin, and immediately accretive cash flows derived from the transformative Kansanshi and Sandstorm acquisitions. RGLD is therefore positioned as a superior core long-term holding for investors seeking high-leverage exposure to precious metals with minimized operational risk, delivering compounding cash flow growth and a secure, perpetually increasing dividend. The convergence of the intrinsic value, the peer valuation gap, and the clarity of the debt repayment plan strongly implies a near-term catalyst for a favorable market re-rating.